Welcome to Voiled Revolution channel. This is a summary of the book Trade Like a Casino by Richard L. Weissman. How to trade like a casino owner, turning market odds in your favor for steady wins instead of risky gambles. This book offers simple steps to find your winning advantage, control losses, and build lasting profits in everyday trading. Overcome emotional traps that drain your account by learning discipline and calm decision-making. Unlock tools to handle market ups and downs, ensuring you come out ahead like the house always does. Let's find out more. We are launching into a deep dive on one of the most fundamental and, I think, critical questions for anyone even remotely interested in finance. Can someone really earn a consistent, reliable living as a speculator?
It's the million-dollar question, isn't it?
It really is. And the consensus answer from everything we've looked at is a pretty strong yes. But, and this is a huge but, it comes with this massive caveat. You absolutely have to transform what feels like a dicey, high-stakes game of chance into a structured, successful business model.
And that's the casino paradigm we're going to explore.
Yep.
Exactly. Our mission today is, well, it's straightforward. We are not trying to reinvent the wheel here. We're adapting a proven, time-tested model where probability is just king. It reminds me of that famous Einstein quote, "You cannot beat a roulette table unless you steal money from it."
A little cynical, but it gets the point across.
It does. Our whole focus is on that challenge. How do you stop being the gambler who always inevitably loses and start becoming the house? The one that always wins over time.
And that casino analogy, it's so much more than just a catchy metaphor. It really is the entire operational blueprint. It's essential to get this right from the start. Success in trading means you have to consistently do things that are, for most people, psychologically just. Fundamentally unnatural.
Yeah.
You're fighting millions of years of evolutionary hardwiring with every click of the mouse. So to really make that shift from a gamble to a career, the casino model demands three non-negotiable prerequisites, three pillars.
And if you neglect even one of these pillars, the whole thing just collapses. You're right back to being the gambler at the table, hoping for a lucky streak.
So what's the first pillar? The absolute foundation.
The first, and where every successful system has to begin, is the development of what are called positive expectancy models. It means the math over a large number of trades has to be undeniably skewed in your favor. It's your mathematical edge.
Right. The casino doesn't care if one person hits a jackpot.
Not at all. A single random event is meaningless to them because they know the underlying math worked out across thousands and thousands of spins. The second pillar, and it's just as critical, is price risk management. This is the casino's table limit.
So how much you're allowed to bet on any single hand?
Precisely. They impose strict limits on position size, on the maximum potential loss. It doesn't matter how sure they are of the odds. They limit their exposure so that one statistically improbable bad run doesn't wipe them out.
And the third pillar. This feels like the one where most people fall down, the human element.
It absolutely is. And it's probably the most challenging. It's unwavering trader discipline. This means absolute, unflinching adherence to the first two pillars, your model and your risk limits, not just when things are going well.
Ah, that's the key?
That's the key. It's 24/7, 365, regardless of whether you just had the best month of your life or the most gut-wrenching, drawdown-heavy week you can imagine. That consistency is the only thing that separates long-term profitability from eventual ruin.
Okay, let's really unpack this, starting right at the foundation, developing that mathematical edge. That's the heart of chapter 1, right? We need to define what positive expectancy actually means when you're in the trenches, trading.
Yes, let's get into it.
Because when we say positive expectancy, it's not just that a trade might make money. It has to be robust enough to survive the real world, to survive the friction of the market. The book talks about deducting for slippage and commissions.
That's a critical point. A model that looks great on paper can be a loser in reality because of those frictions. For anyone who isn't deep in the jargon, slippage is what happens when you try to execute an order at a certain price.
But the market moves so fast, you get filled at a worse price.
Exactly. Or there isn't enough liquidity. So if your model's expected profit on a trade was, say, only 5 ticks, and you consistently lose 2 ticks to slippage on your entry and exit, well, you've just destroyed a huge chunk of your theoretical edge.
So a truly positive expectancy model has to have a big enough edge to absorb those costs and still be mathematically profitable over the long haul.
It has to. The casino builds the cost of the lights and the staff into its odds. We have to build the cost of commissions and slippage into our models.
Which leads us straight to the tool for doing this, technical analysis. The book really argues that its strength is this core idea that price has memory.
It's a fascinating concept because it's grounded not in economic theory, but in mass psychology and historical human behavior. The classic example is always a commodity like crude oil. If crude hit a major psychological resistance level at, say, $40 a barrel back in 1990, it's almost uncanny how that same horizontal line on a chart will act as resistance again years later, maybe in 2005 or 2015. The market collectively remembers that price.
And I could just hear the economists screaming at that idea. Because fundamentally, the value of a dollar is completely different between 1990 and 2015.
Completely different.
The geopolitics, the extraction costs, global demand, everything is different. Logic, like purchasing power parity, would say that $40 then shouldn't mean anything now. And yet
the sources are clear that the memory of that price level persists and demonstrably influences how people trade today. It's driven by human emotion and habit, not economic purity.
Which really highlights the big challenge of using fundamental analysis for a rule-based system.
It does. I mean, fundamental analysis, looking at earnings, macro trends, balance sheets, is vital for understanding long-term value. But for day-to-day speculation, it is just too subjective. You can always, and I mean always, find a compelling fundamental argument to buy and a compelling argument to sell at almost any price.
Which is why a market exists in the first place.
Exactly. And that subjectivity leads to what the author calls paralysis from analysis. You're just so bogged down in conflicting valid arguments that you can't act. Or even worse, you just pick the analysis that confirms what you emotionally want to do anyway.
So if the fundamentals are too subjective for rules, how do you build them?
You have to rely on objective, mathematically derived technical indicators, things like oscillators, your RSI, your stochastics, or moving averages, or volatility measures like ATR. These tools don't care about a CEO's opinion or the Fed's next meeting.
They just care about the numbers.
They only care about the mathematics of price and volume, and that's what provides the necessary objective rules for entry, for exit, and for risk management that lets you sidestep those psychological traps. It's really the only way to build a system you can repeat consistently.
And the reason these mathematical systems can even work, the reason there's an edge to be found at all, is because of the market structure. If markets were perfectly efficient, this would all be a waste of time.
That's the core insight. We have to understand that financial markets display what's called a leptokurtic, or fat-tailed, distribution. It is not a normal bell curve.
Okay, break that down. What does fat-tailed mean for a trader?
It's a technical way of saying that extreme moves, the tails of the probability curve, happen much, much more frequently than a purely random model would predict. That statistical inefficiency, that's the crack in the system that allows positive expectancy models to exist.
So if it were a perfect bell curve, everything would just cluster around the average price and it'd be impossible to make money after costs.
Almost impossible. The fact that huge directional moves or dramatic snapbacks to the average happen more often than they should, those are the fat tails. That's where the opportunities are. And this inefficiency really drives the two primary types of models that every professional uses.
Okay.
On one hand, you have counter-trend models. These make money from the market's tendency to revert to the mean, to snap back to its average price during normal periods. Then on the other hand, you have the trend-following models.
And they're going after the fat tails themselves.
Exactly. They're designed to capitalize on those statistical anomalies. The rare, huge, directional moves that happen less often, but can produce absolutely career-making profits when they do.
This all sounds fantastic on a spreadsheet, but now we hit that brick wall, the human brain. The problem, as defined by Kahneman and Tversky, is prospect theory. and it seems custom designed to destroy both of those profitable models.
It is, without a doubt, the single most devastating psychological bias a trader has to overcome. Prospect theory proved, empirically, that we humans are fundamentally risk-averse when it comes to gains, but we are risk-seeking when it comes to losses.
So what does that mean in practice?
It means we are hardwired to snatch a small, quick profit because we're terrified of losing the little bit of gain we have. That's the risk aversion. And on the flip side, we are wired to hold on to a massive losing position, hoping and praying for a miracle rally just to get back to break even. That's the risk-seeking part. We'll risk a lot more just to avoid booking a loss.
Taking small profits and big losses, the absolute recipe for disaster. It really explains the author's famous advice. If it feels good, don't do it.
That's it in a nutshell. If a trade feels comfortable and easy, you're almost certainly acting on that flawed wiring. You're probably taking a profit way too early.
Or avoiding a loss that you know you should take.
Exactly. Just think about executing those profitable models. For a trend follower, buying a new all-time high feels absolutely terrifying. Your brain is screaming, "This is the top. You're the sucker buying at the peak."
And for a mean reversion trader, buying when there's blood in the streets, when the sentiment is overwhelmingly bearish?
It feels like jumping in front of a freight train. But those are precisely the moments where the highest probability trades exist because you are exploiting the inherent predictable biases of everyone else who's trapped by their own psychology.
This brings us back to the stark reality that just being right about the fundamentals isn't nearly enough. You have to survive, which is where that cautionary tale about SEM Group comes in.
The SEM Group story from the 2008 oil crash it's the perfect, brutal example of why risk management and timing will always trump being right in the long run. SEM Group, they were an oil trading firm. They correctly figured out that oil prices heading towards $147 a barrel were completely unsustainable.
So their analysis was spot on.
Flawless. They knew it was a bubble, and they started shorting it around $100 a barrel. But the market, driven by pure momentum and FOMO, just kept screaming higher.
They were too early.
Way too early. They filed for bankruptcy on July 22, 2008, while oil was still near its peak. The price eventually collapsed and bottomed out at $32.48 in December, so they were 100% right about the outcome. But they were 5 months too early and positioned way too aggressively to survive that final irrational spike.
Wow. The lesson is just brutal. Being right over the long run can be fatal. You have to be right in the right season.
That's it. If you don't manage your risk, if you don't size your positions correctly, the market can stay irrational long enough to take every dime you have, even if your thesis is eventually proven correct.
So SEM Group's failure wasn't a failure of their analysis. It was a failure of the second and third pillars, risk management and discipline. It all comes back to needing objective rules. So where does something like trader's intuition fit into this? Is there any place for it?
You have to be extremely careful with the concept of intuition versus rules. If your intuition is just an emotional excuse to break your rules, to abandon your model or ignore your stop loss, then it's poison. It has to be avoided at all costs. That's just gambling with a fancy name.
But is there an authentic version of it?
The author suggests there is, among very experienced professionals. But it's not magic. It's more like a highly refined subconscious pattern recognition, a memory of similar market setups that you can't quite articulate mathematically in the moment.
So your model might say, enter here, but your gut says, I've seen this kind of volatility spike lower before the real move starts.
Precisely. That gut feeling is just a fuzzy, fast recall of past patterns. But, and this is the most important part, even when that kind of intuition is real and effective, it is never a license to abandon your hard risk rules. Your model defines the maximum risk. Your intuition might, maybe, help you refine the entry point a little, that's all.
Okay, so once we have that positive expectancy model, we immediately have to bolt on that second pillar. Price risk management. This is the insurance policy, the thing that guarantees you live to trade another day. The book makes it clear a positive model alone is just not enough. You need this three-tiered risk management pyramid.
Right, and that pyramid structure is a great way to visualize it. It shows how comprehensive risk control has to be. It isn't just one rule. The base is your classical non-negotiable tools. The middle is about the portfolio level. And the apex is that necessary human judgment call under extreme conditions.
Let's start at the bottom. The base tier, classical quantitative tools. And the absolute cornerstone here has to be the stop loss.
It is the essential foundation. The stop loss is so critical because it forces you to quantify your maximum risk before you even enter the trade. That's the key to objectivity.
Because once you're in the trade, your emotions take over.
Greed, fear, hope, they all cloud your judgment. But a stop-loss order placed in the market, it can't rationalize, it can't hope, it can't debate the fundamentals. It just executes the exit at your predetermined loss level. It takes the decision out of your emotional hands and limits the damage to a calculated, manageable amount.
And a stop-loss is meaningless without proper volumetric position sizing. This is where the famous 1% rule comes in, risking no more than 1% of your capital on any single trade. Why is that specific link so vital?
Because that 1% rule is what prevents the death spiral. Your actual dollar risk on a trade is a function of two things: how far away your stop loss is and how many shares or contracts you're trading. If you're trading a very volatile asset that needs a wide stop loss for technical reasons,
Then you have to trade a smaller size.
you absolutely must. You have to reduce the number of contracts to keep the total dollar risk at that 1% threshold. For example, with a $100,000 account, your max risk is $1,000. If your stop is $2 away, you can buy 500 shares. But if the volatility demands a $10 stop, you can only buy 100 shares.
The professional is always asking, how much can I lose if I'm wrong? Not, how many shares can I buy?
That is the professional mindset. This adjustment is the practical mathematical definition of the casino's table limits. Without it, even a correct long-term view can get you wiped out by short-term noise that hits your technically necessary wide stop.
Okay, moving up the pyramid to the middle tier. This is about risk at the portfolio level, and this is where you start considering things like correlation between your assets. The main tool here is value at risk, or VAR.
Right, VAR is used by almost every major institutional fund. It's a statistical tool that tries to answer a very specific question.
I want that question.
It's, what is the likelihood of my entire portfolio losing X dollars or more over a specific time under normal market conditions? So a hedge fund might say their daily VAR is $30 million at a 95% confidence level.
Meaning there's a 95% chance they won't lose more than $30 million tomorrow.
Correct, but that emphasis on normal market conditions is the scary part, especially after what we said about fat tails. The 2008 financial crisis basically blew up a lot of VAR models, didn't it?
It seems like their biggest flaw.
It is. The flaw is that VAR assumes historical correlations between assets will hold up. But during extreme stress, a true fat tail event correlations go to 1. Everything starts moving down together. The 95% confidence level is great for normal days, but it tells you absolutely nothing about what happens on that other 5% of days, which is when you can lose everything.
So VAR isn't enough on its own.
Not even close. Which is why it has to be paired with the second tool in this tier, stress testing. Stress testing is where you actively simulate those extreme, non-normal scenarios. A credit crisis, a geopolitical shock, a flash crash. You see how your portfolio holds up under conditions that the VAR model basically ignores.
It's forcing yourself to prepare for the disaster scenario.
Exactly. And that brings us to the very top of the pyramid, the apex tier, which is management discretion. This is where the human element comes back in, but in a very specific, disciplined way.
So it's not just trading on a whim.
No, absolutely not. This layer is an admission that no quantitative model can predict every single black swan event. Management discretion is the seasoned judgment of experienced managers who can augment the quantitative tools, especially during a crisis where the models might be breaking down or spitting out nonsense signals. It's a qualitative overlay born from years of experience, not an emotional impulse.
This entire structure, this pyramid, it requires a complete mental reboot for most people on how they think about losing.
It does. You have to adopt the casino's mindset. Always expect and be prepared for the worst-case scenario. The author has a great line. Any idiot can take a profit. Professionals know how to take losses.
That's powerful.
It's about efficiency. The faster you can identify a trade as a probable loser and exit for small contained loss, the better. You free up that capital for the next higher probability opportunity. Risk management is a business of no fooling, no second chances. It has nothing to do with ego or being right. It's just survival.
Which leads us perfectly into that third pillar, the one that ties it all together, maintaining unwavering discipline. This feels like the final boss for most traders. You can have the best model and the best risk rules, but if you can't execute them flawlessly, it's all for nothing.
It is the psychological crucible. And discipline, in this context, is defined as the prerequisite consistency for success. It's about maintaining that casino attitude, being totally emotionally unaffected by your recent results. The author is very clear. The only acceptable reason to stop using a positive expectancy model is to replace it with an even more robust back-tested model.
You don't abandon it just because you had a losing week.
Never. The book uses this great thought experiment of an opaque urn. Imagine an urn with 57 green marbles and 43 red ones. Your statistical edge is obviously to bet on green.
Right.
But what happens if you bet on green and you pull 4 red marbles in a row? The novice trader starts to panic. They doubt the math, they doubt the urn, they abandon the strategy, even though the statistical edge is still firmly mathematically in their favor.
That's the core challenge. The market gives you random outcomes in the short term.
And you have to have the discipline to see past that randomness. The casino doesn't panic when a player hits a lucky streak. They just keep dealing because they know the math works out over thousands of hands. Traders have to internalize that 4 losses in a row is just a statistically normal event. It has zero bearing on the long-term viability of their strategy.
But even the best strategy might not work for everyone. There's this idea of matching the model to personality.
Yeah.
The psychological demands must be pretty different for different styles of trading.
Oh, massively different. It's a critical piece of self-assessment. Take trend followers. Their whole game is aiming for huge profit-to-loss ratios. They're risking $1 to make 5 or 10 or even more. They're holding trades for weeks or months.
But what's the psychological price for that?
The price is that you have to accept a huge number of small, annoying losses. The author calls it death by 1,000 paper cuts. You just lose a little bit at a time while you patiently wait for that one massive winner that pays for all the losers and then some. It takes incredible patience and a high tolerance for being wrong most of the time.
And what about the other end of the spectrum, the day trader?
The day trader has a totally different psychological profile. They're in and out within the day, so they have no overnight risk, which is a big plus. But because they're taking much smaller profits, their models have to have a much higher winning percentage to be profitable.
And they're making dozens of decisions under pressure.
They're married to the screen. The moment-to-moment stress is immense. Their discipline has to be instantaneous. Their primary risk tool, beyond a normal stop, is often just the clock itself. They're making decisions based on 2 or 5 minute charts.
But no matter which model you choose, the book says the most common failure of discipline is the failure to take losses quickly. Why is just admitting we're wrong so hard?
It's drilled into us from birth. In school, in sports, in our careers. We're taught that losing is bad. We associate losing money with being a loser. The paradox in trading is that the biggest winners are the ones who have successfully disconnected their ego from the outcome of any single trade.
They just see it as a business expense.
A cost of doing business. As soon as a trade violates its premise, they're out. No emotion, no hesitation. It's not a personal failure, it's just data.
And the danger isn't the small loss itself. It's falling into that trap of trading not to lose.
That's the death spiral. That's when you're so desperate to avoid booking a loss that you're willing to endure a massive escalating loss way past your 1% rule, just hoping to get back to break even. It's pure prospect theory in action.
And the market will sometimes reward that bad behavior, which is the worst thing that can happen.
It's the worst. It gives you a little win that reinforces a toxic, catastrophic habit. You get away with it a few times until that one time the market doesn't come back and your account is gone.
So the masters, they're just focused on the process, on the math, not the random outcome of any single spin.
Exactly. And that discipline isn't just about what you do, it's also about what you don't do. The discipline not to trade patience is so underrated. If your model is for a mean reverting market and that market starts trending like a freight train, you have to have the discipline to just sit on your hands.
Even when it feels like everyone else is making money.
Especially then. The adage is simple. When there is nothing to do, do nothing. You can't force an opportunity that your model doesn't see.
That is so hard, though. That patience is excruciating when you're watching the market rip higher.
It is, because the present price action just distorts your view of the future. You forget that volatility is cyclical. The antidote is to constantly remind yourself of that cycle. Low opportunity periods always lead to high volatility periods, and vice versa. And you have to avoid what the author calls the Protestant work ethic in trading.
The idea that you have to be busy all the time to be productive.
Exactly. You can't force the market to give you more money than it's currently offering. If your model says the probabilities are low, the professional trader is happy to make zero or a tiny gain and just wait for a better setup.
That really covers the three pillars. It's a huge mental shift. Okay, let's move into part 2 and get into the practical tools and techniques from chapters 4 through 9 that let you actually execute this paradigm. We can start in chapter 4 with the only constant we have.
The volatility cycle.
Right.
As we said, you can't guarantee direction or time or anything else. But the author argues that the cyclical nature of volatility moving from low to high and back again is the market's one guarantee.
Which means volatility indicators aren't just a sideshow. They're critical for model building because they tell you which type of market you're in. They signal that shift between mean reverting and trending.
That's the key. They tell you which side of that fat-tailed distribution is active right now. If volatility is high, the market is usually trending, so you want your trend-following models. If volatility is low, the market is usually coiling up, moving sideways, which is perfect for counter-trend models. The shift from one to the other is the signal.
Let's walk through the book's example of building a breakout system, a positive expectancy model designed specifically to catch those high volatility moves.
Okay, so this model needs 3 integrated parts. First, you need an objective way to measure low volatility. The tool for this is narrow Bollinger Bands. When those bands squeeze together tightly, it's a visual sign that the market is coiling up. A big move is statistically likely, you just don't know which direction yet.
So that's the setup. What's the trigger?
The second part is the breakout confirmation. You define this as a candle closing decisively above the upper band for a buy or below the lower band for a sell. That's the confirmation that the coiled energy is being released in a specific direction.
And of course, the third part has to be risk management.
Absolutely non-negotiable. For this kind of trend-following trade, you need a trailing stop exit rule, something that gives the trade room to breathe but still protects you. The book suggests a simple, robust rule. For a long trade, your trailing stop is the lowest low of the previous 3 days. For a short, it's the highest high of the previous 3 days.
So you're combining the volatility signal for entry with a clear, objective rule for the exit.
Exactly. It lets you capture the trend while protecting yourself from the inevitable whipsaws if the breakout fails.
All right, chapter 5 deals with a really deep psychological trap, trading the markets, not the money. This is when you stop looking at the chart and start looking at your P&L, right?
It's a classic novice mistake. You fixate on the dollar amount. Wow, I'm up $10,000. That's a new laptop. And that emotional attachment to the money causes you to exit way too early, breaking the rules of your positive expectancy model.
Think back to that crude oil example from 2008.
Perfect example. When crude dropped from $147 to $135, that's a $12,000 gain per contract. A trader focused on the money sees that $12,000, gets scared of losing it, that's prospect theory again, and takes the profit.
And then they watch in agony as the market drops another $100 a barrel without them.
Because they were trading the money, not the market. Trading the market means your decisions are dictated by the price, action, support, resistance, volatility, not your emotional reaction to your account balance.
This also relates to what the book calls the baby needs a new pair of shoes. Poison.
Huh. Yeah, it's a great phrase. It comes from old craps players who are just trying to win enough for one specific purchase. It highlights the danger of forcing your personal financial needs onto the market.
Like trying to make your mortgage payment on a single trade.
Exactly. The market could not care less about your mortgage payment. It operates on its own laws of supply and demand. When you think in those personalized terms, you're blind to the actual probabilities, and you'll inevitably break your rules to try and hit some arbitrary dollar target.
And the flip side of that coin is the house's money delusion.
Right. Yes, this happens after a big winning streak. You start thinking you're playing with the house's money, so you get reckless and abandon your risk rules. You think you can afford to lose it.
But it's of your money.
So as soon as it's in your account, it is your capital. And it deserves the exact same disciplined risk management as every other dollar. The professional response, whether you're on a winning streak or a losing streak, is to ignore the cumulative P&L and just ask one question. Am I following my model and my risk rules? If yes, you keep trading. The P&L is just the score, it's not the coach.
Moving on to Chapter 6, this is about managing another powerful emotion. Regret. Minimizing trader regret. This emotion can be so destructive because it makes you change your behavior on the next trade.
It's a huge problem. The book identifies two main sources of regret we have to neutralize. The first is watching a big, juicy, unrealized profit evaporate and turn into a realized loss. That one really stings.
I can imagine.
The second is taking a small, satisfying profit, feeling good about it, and then watching the market explode in your direction right after you get out.
So you need to build specific regret minimization techniques right into your trading plan. How do you stop those unrealized profits from disappearing?
The first technique is pure risk management. You simply do not allow a profitable trade to turn into a loser. This means as soon as the market moves significantly in your favor, you move your stop loss up to your entry point to break even. Now it's a risk-free trade. If it reverses, you get out with zero loss and you've eliminated that first source of regret.
Okay, that protects the downside. But how do you handle the regret of getting out too early? How do you still catch that massive fat tail move?
That's where the second technique, strategic partial profit taking, is essential. The idea is to take, say, 50% of your position off the table at your first logical profit target, a key resistance level, for example.
So you bank a definite win.
You secure a gain. That satisfies that human need to book a profit. It's a huge emotional victory. But crucially, you now have the other 50% of the positions still working for you. You can manage that remaining piece with a much wider trailing stop, giving it plenty of room to run and potentially catch that huge, unpredictable move. It minimizes the regret of leaving too much on the table.
It's about being good enough rather than being perfect.
Perfection is the enemy in trading. You just want to capture the fat middle of the move.
All right, Chapter 7 brings in a foundational tool, time frame analysis. This is about looking at the market on multiple levels, right? The monthly, weekly, and daily charts all at once.
Yes, it's a constant reminder that the trend is always relative to the time frame you're looking at. An asset can be in a beautiful multi-year uptrend on the monthly chart, but at the same time, it could be in a nasty bearish pullback on the daily chart. Professionals use this complexity to their advantage, specifically by looking for time frame divergence.
Okay, what is time frame divergence, and how does it create a low-risk, high-reward entry?
Divergence is when the shorter-term charts are out of sync with the dominant longer-term trend. So let's say the weekly chart is in a strong, clear uptrend. The underlying market direction is bullish.
Yeah.
But then the daily chart shows a sharp, short-term pullback. It's looking weak, maybe hitting an oversold reading on an indicator like RSI. That's a divergence. The short-term picture disagrees with the long-term one.
And that's your entry signal.
That's your high-probability entry signal. You use that short-term weakness on the daily chart as your entry point to get long in the direction of the powerful weekly trend. It allows you to buy the dip within a strong uptrend. You get a tightly defined stop loss based on that short-term low, so your risk is small, but your profit potential is huge because you could ride the entire next leg of the major weekly trend. It's the art of buying weakness inside of strength.
Let's get into the models themselves in Chapter 8, how to use trading models. The book distinguishes between mechanical systems, which are purely mathematical, and non-mechanical systems.
Right. And with non-mechanical systems, things that use classical tools like trend lines or Fibonacci retracements, the key is that the indicator itself is never the whole system. You have to build the rules around it. You need predefined rules for your stop loss, your position size, and your profit-taking strategy.
The book uses Fibonacci retracements as a good non-mechanical example. How would that work in practice?
Fibonacci levels are used to identify areas where a pullback within a trend is statistically likely to find support and then resume the trend. The key levels are usually 38.2%, 50%, and 61.8%. Using this tool really forces you to know your own risk tolerance.
How so?
Well, a more aggressive trader might enter at the very first level, the 38.2% retracement. They accept a higher risk that the price might pull back further, but they have the lowest chance of missing the move entirely. A more conservative trader, on the other hand, might wait patiently for the deeper 61.8% retracement.
So they have a much lower risk entry, but a higher chance of the market turning before it gets to them.
Exactly. They might miss the trade. But the core principle is the same for both. The stop-loss placement, tied to that 1% risk rule, is always more important than the exact entry price.
Let's shift to a specific model for day traders. Gap trades in the equity market. How do you build a system around the opening gap?
A gap trade is all about capitalizing on that price difference between yesterday's close and today's open. The system requires you to first define an opening range. You quantify the price action for a set period, like the first 15 or 30 minutes of trading. The high and low of that period become your key levels.
And the trade is to buy the breakout above that range or sell the breakdown below it.
Correct. And crucially, your stop loss is immediately placed on the opposite side of that range. If you buy the breakout above the 15-minute high, your stop goes just below the 15-minute low. Your risk is immediately defined and contained by the market's own short-term structure.
And professionals will look for some kind of confirmation.
Yes, you want to see that breakout happen on increasing volume, for example. Or maybe it also breaks the previous day's high, something that validates the strength of the move and increases the positive expectancy of the trade.
Okay, finally, Chapter 9. This tackles a huge psychological killer, the perfection trap. This is that desire to buy the absolute bottom and sell the absolute top.
It's a deep-seated desire for reward without risk, for a perfect, comfortable trade. And this emotional need for perfection leads directly to the single most costly mistake a trader can make, anticipating the signal.
So getting in before the market is actually confirmed to turn.
Exactly. It's entering a trade based on a feeling. This stock has gone up too much, it has to turn around now. You're trading based on what you think the market should do instead of reacting to what it's actually doing.
As Keen said, the market can stay irrational longer than you can stay solvent.
And that final irrational blow-off top is where anticipatory shorts get absolutely destroyed. The solution is so simple to say, but takes incredible discipline to do. Don't anticipate, just participate.
Wait for the evidence?
You wait for objective evidence, a technical signal defined by your rules that a reversal has actually started. You participate in the proven trend until the market itself tells you that the direction has changed. This is why you must always trade value over price. Don't avoid buying something just because the price feels high. You trade based on the market's dynamic support, resistance, volatility. You have to completely let go of perfectionism and embrace robustness. You don't need the top and bottom. The middle 80% of a move will make you rich.
We've covered so much ground. The 3 pillars of the casino paradigm and the tools you need to execute it. It really is a complete roadmap for making that transition from gambler to the house.
It's a massive shift, and it all culminates in that one psychological state of the master trader, even-mindedness. This is about trading without any emotional attachment to winning or aversion to losing on any single specific trade. It's about truly, deeply accepting that losses are just an unavoidable cost of doing business.
A necessary expense for executing any positive expectancy model.
Any of them.
Yeah.
You have to internalize that the market is uncertain and always changing, but that uncertainty is exactly what creates the opportunities. So you strip away all the delusional biases. Blaming the market, avoiding trading on Tuesdays, feeling like you're being killed by a losing streak, and you just focus on the process.
And there's an affirmation the book suggests for those tough times, for those drawdowns.
Yes. When that negative self-talk starts, you just calmly repeat to yourself, I am employing a robust, positive expectancy trading model and am appropriately managing risk. I will confidently continue trading. It forces you to believe in your process, which is the only thing you can actually control.
That distinction is everything, isn't it? Controlling the process, not the outcome. The paradox of the master trader seems to be this ability to have unwavering discipline without being rigid. They just accept small losses as the price of admission to enjoy those outsized profits.
And that acceptance, that deep down whatever happens, happens attitude toward any one trade, that's often the final psychological piece of the puzzle that lets a trader break through from failing to succeeding. It's about managing the fear so you can capitalize on the opportunity.
So we'll leave you with a final provocative thought to consider. Given everything we've discussed about the cycles of volatility and the discipline it takes to wait for your edge, what specific self-imposed barrier, maybe it's emotional profit-taking or trading out of boredom, what barrier will you commit to replacing with a documented, rule-based methodology this week? Thank you for watching. Please like, share, subscribe, follow up, and next topic.
Welcome back to the Deep Dive. We are going to continue our journey into what is, I think, one of the most essential trading blueprints out there, Trade Like a Casino by Richard L. Weissman.
That's right. And for the past few weeks, we've really laid down the quantitative foundations. We've talked about the positive expectancy models, the ironclad risk management.
The bedrock, really. The math that says if a casino has these things in place, well, they have to win over time. It's a statistical certainty.
It is. But there's this huge unstable if that hangs over the entire thing.
And that if is us, the human element.
Exactly. It doesn't matter how brilliant your model is, how perfect your math is, your own mind can and often will sabotage the entire operation in a single moment of fear or greed.
So that's our mission today. This is, I would argue, the most important part of this whole deep dive. We are plunging headfirst into part 3, trader psychology.
Yep, chapters 10 through 12. We're moving past the charts, past the numbers, and we're going to unpack that relentless emotional roller coaster that is speculation.
The goal here is to really understand how the professionals achieve psychological mastery, how they make sure that their robust, well-researched systems aren't just destroyed by a self-inflicted wound.
And this gets right to the core of why trading is so hard. The author says it's maybe one of the most difficult careers known to humankind.
And the reason is fascinating. It's because success demands that you consistently do what is, and I'm quoting here, psychologically uncomfortable and unnatural.
I mean, just think about that for a second. We are all wired, biologically, socially, to seek pleasure and avoid pain. It's how we survive.
Right. And in trading, that's the prospect theory bias we see everywhere.
It is. That overwhelming urge to snatch a tiny profit just to get that little hit of dopamine, to feel good. And the equally powerful urge to let a losing trade run, just hoping it comes back so you don't have to feel the pain of being wrong.
But successful trading is the exact opposite of that. It's about taking small, frequent, manageable losses and letting your winners run. It's completely unnatural.
Completely. So today we're diving into how you strip away those deep-seated, frankly delusional beliefs and start reinforcing productive, probability-based behavior. How you move from being a nervous novice to a disciplined master who really can think like the house.
Okay, let's unpack this. Before we can even start looking inward at our own psychology, the book says we have to accept the external reality. The market itself.
Yes, you have to achieve total acceptance of the environment. And there are these essential truths about how markets behave that beginners, well, they just consistently deny. And that denial leads to massive psychological instability.
So what's the first truth they deny?
They deny the complexity. Markets are defined by 3 core characteristics. They are multifaceted, they are uncertain, and they are ever-changing.
And the novice comes in looking for the simple answer.
Always. They're searching for the tic-tac-toe solution, the one magic indicator that's going to tell them when to buy and when to sell. They want certainty in a world where certainty just doesn't exist.
The search for the holy grail of trading. I think we all started there, didn't we? Looking for that one simple trick.
We did. And that search is just disastrous because the reality is, as the author puts it so well, it's like three-dimensional chess. It's not a simple, linear game.
Three-dimensional chess. I like that.
It's not just reacting to price. It's reacting to politics, economic cycles, sentiment, order flow, quant models, all of it, all interacting at the same time.
So success isn't about finding a simple trick. It's about embracing that complex casino paradigm we've been talking about.
That's it. Positive expectancy, robust risk management, and the discipline to stick to it. That's the only answer.
And when beginners face this complexity, this three-dimensional chess, they try to impose their own rules on it, right? To make it simpler.
They do. They create these psychological limits. They'll say things like, oh, I don't trade before holidays, or I never trade during this time of day.
Based on what? The feeling?
Exactly. Unless those limits are based on rigorous, back-tested risk logic, they are just psychological biases. They're designed to reduce the feeling of complexity, but what they actually do is severely limit your chances of success.
Okay, so that denial of complexity leads right into the second characteristic. Markets are inherently uncertain.
Uncertainty is guaranteed. Always. In every market. Full stop. This is the truth that a successful trader has to just wrap their head around and embrace completely.
Because if you
don't, you'll abandon your risk management. If you start to believe, even for a second, that the outcome of a trade is certain, you'll stop using stops. And that's the end of the game.
And that's where the idea of thinking in probabilities comes in. The book calls it the greatest antidote to these concretized trader biases.
It is the ultimate antidote. I mean, if you truly accept uncertainty, then you have to accept that any price is possible. Any and all outcomes can happen.
So you stop trying to be right about the next tick.
You do. You stop focusing on being right, and you start focusing on executing your edge, your system, flawlessly. You know that over 1,000 trades, the probabilities are on your side, even if the next 5 or 10 or 15 trades are losers. It replaces that emotional need for certainty with cold, objective probability.
Which flows perfectly into the third truth. Markets are ever-changing.
There's no finish line. There's no static plateau of mastery where you can just rest.
Right. The model that worked perfectly last year might get you killed this year.
Absolutely. You could have a model that's brilliant in a rising inflation environment, but if you rigidly cling to that when the whole paradigm shifts, you will fail. It's guaranteed.
So you have to be flexible. You have to constantly be refining.
Yes.
Yeah.
And we'll get more into that when we talk about the master trader. But these three truths, that markets are multifaceted, uncertain, and ever-changing, you have to internalize them. They have to become your reality before you can do any of the inner psychological work.
Okay, so once we accept the market's reality, then we have to turn inward and look at the hurdles we put in our own way. And the author uses this really interesting framework here, maras.
Yeah, from Buddhist cosmology. It's a powerful way to look at modern self-sabotage.
So what are they? What are maras?
They're described as obstacle makers, but they aren't external demons or, the market being out to get you. They're internal psychological states that block objective perception.
They're our own inner conflicts.
They're externalizations of our own inner conflict. They represent the parts of our ego, our mind, that are just fundamentally at odds with what it takes to be a successful speculator. We're going to focus on the two big ones that absolutely ruin trading careers.
Well, let's start with the big one, the one that I think everyone who has ever placed a trade has felt. The Mara of death, the fear of loss.
It's the foundational obstacle. It's universally seen as the single greatest threat to your trading account, and it's rooted so deep in our social conditioning.
We're taught from childhood that losing is bad. Losing money means you're a loser. Being wrong is failure.
Right. We're taught to avoid loss at all costs. But in trading, losses aren't just possible. They are unavoidable. They are a necessary, predefined cost of doing business. It's like the inventory cost for a shopkeeper.
So the book maps out this this emotional spiral that traders go through when they face a loss. Using the Kubler-Ross model of grief as an analogy, it starts with denial.
Denial.
Yeah.
This is that hope, conscious or not, that you can find a system that just wins, that you can have gain without any possibility of loss.
But that's a denial of the probabilistic nature of the whole thing.
It is. And it's so dangerous because if you're in denial about the possibility of loss, you never plan for it. You don't set a stop loss.
Yeah.
You don't size your positions correctly. You're flying blind.
And when that denial is shattered by a real loss, what comes next is anger.
That emotional flare-up. You get angry at the market, at your system, at your broker.
Or yourself for being wrong.
Mostly at yourself. It's the ego just lashing out because it realizes it's powerless. And the book's advice here is so critical.
What's the professional response?
You have to acknowledge the anger. It's a natural feeling. But then immediately, you deepen your breathing, you release the physical tension, and you calmly assess the situation before you do anything. You absolutely cannot trade effectively when you're angry.
Because that leads to revenge trading.
Immediately. And that's a death sentence for an account.
So after anger, we get to stage 3, bargaining. This is where I think we see prospect theory just wreak havoc.
This is the classic signature of a novice trader. Bargaining is desperation. It's clinging to, superstitious behaviors thinking your lucky shirt will save the trade.
Or more seriously, it's abandoning your proven model.
That's the critical failure. You abandon your positive expectancy model because you're just hoping to get back to break even, or maybe grab a tiny profit so you don't have to take the loss.
Can you walk us through what that actually looks like in a real trade?
Sure. Imagine you go long a stock, and your model says your stop loss should be at $95. The price immediately drops to $95.50. The model is screaming at you to get out, take the small loss.
But the Mara of death whispers in your ear.
It whispers, hey, if you just hold on a little longer, it'll bounce. You can get out at break even. You won't have to feel the pain of this loss. So what do? You move your stop down to $90.
You bargain?
You bargain. Then the price drops to $92, and you do it again. You move the stop to $85 because now the market owes you. Before you know it, the price is at $70. And that small, manageable, professional $5 loss has turned into a catastrophic, account-threatening $30 loss.
All because the ego couldn't handle the pain of being wrong in that moment.
You're trading not to lose instead of trading to win based on your probabilistic edge. It's a fatal mindset.
And when that bargaining fails and the market just keeps falling, it leads to stage 4, depression, despondency.
Yeah, trader burnout. That feeling of being totally powerless, completely defeated, and what you resist persists. The more you try to deny that feeling, the stronger it gets.
So what's the antidote?
Acceptance. Not denying the emotion, but accepting reality without letting those feelings disable you. You have to accept the market is what it is. Multifaceted, uncertain, ever-changing, and that you are powerless over that environment.
Which brings us to the final necessary stage for any kind of psychological freedom, acceptance.
This is it. This is the non-negotiable shift you have to make. You completely accept the nature of the market, and you accept that your ego has zero, and I mean zero, control over what the next price tick will be.
And ironically, that's what frees you.
It's what frees your objective perception. It removes all the emotional baggage that you've tied to the idea of a loss. You overcome the Mara of death, not by fighting it, but by accepting it.
Okay, let's move to the second big psychological obstacle, the Mara of the Son of the Gods. This one sounds a bit more subtle because it's not about pain. It offers pleasure.
It does. It offers the pleasure of perfection or the illusory peace of inaction. This is what the book calls the perfect trader syndrome.
What does that look like?
It's that obsessive desire to buy the absolute low tick and sell the absolute high tick. It's trying to capture 100% of a move and completely eradicate any feeling of regret or emotional pain.
And it also includes the false comfort of just staying out of the market, right? Even when your system gives you a signal.
That's a huge part of it. Your system fires a valid, positive expectancy signal. But you hesitate. You stay flat because the entry feels too scary or it doesn't look perfect. You're choosing the illusory peace of being out of the market over the discomfort of taking a calculated risk.
We've talked about this before, the rookie mistake of anticipating the signal, trying to pick the exact top or bottom instead of just writing the trend.
That's the very embodiment of it. You're seeking psychological comfort and the reward of being perfectly right without being willing to endure the necessary risk.
But how do you draw the line? I mean, some anticipation is just good analysis, isn't it?
That's a great question and a critical distinction. Informed analysis is what you use to build your system in the first place. It defines your edge. Anticipating the signal is when you override your tested system based on an emotional hunch.
Because you feel like the market is about to turn.
Exactly. The professional's mantra is simple. Don't anticipate, just participate. You follow your system, you participate in the trend that your model has identified, and you stay in it until you get clear evidence that it's reversing. You trade the system, not the feeling.
So if the Mara of death is about the fear of pain, which stops us from taking our losses,
Then the Mara of the Son of the Gods is about the fear of imperfection, which stops us from fully taking our high probability trades.
two sides of the same destructive coin.
Absolutely. Both are rooted in the ego's desperate need to control an uncontrollable environment and to avoid the emotional discomfort that is just part of probabilistic trading. Recognizing them in your own behavior is the first huge step.
Okay, so once you start identifying these internal opponents, you need a way to, I guess, observe and quantify them. Which brings us to Chapter 11 and the need for rigorous self-examination.
Yeah, in trading, you can't blame your boss. Can't blame your coworkers. The accountability is absolute. Know thyself isn't just a philosophical saying, it's a business imperative.
Self-examination is the only way to get past your own delusions about your performance.
100%.
Yeah.
If you're not profitable, the problem is your methodology, your risk management, or your execution. That's it. And the tools for this kind of self-diagnosis might seem tedious, but they are absolutely invaluable for shining a light on your blind spots.
The book lays out this really comprehensive due diligence questionnaire. It forces you to go way beyond just, looking at your P&L statement at the end of the month.
It's a systematic analysis of your entire operation. It starts with you, the trader, assessing your time constraints, your financial limits, and most importantly, your deep psychological biases.
What kind of deep psychological questions does it force you to ask?
It forces you to quantify your resilience. The questions are brutal. It's not just, are you disciplined? It's, what specific, tangible plan do you have in place to stop yourself from giving up during a massive drawdown?
And the flip side of that, too.
Right. What precise steps will you take to prevent yourself from getting reckless and over-leveraging during a hot streak? And the answer can't just be, oh, I'll try to be careful.
It has to be a real plan.
It has to be a detailed procedural plan. What affirmations will you use? What's your meditation schedule? How will you review your back-tested results to ground yourself? You need a concrete plan to manage your own emotional cycles before they happen.
That reframes it completely. You're not just experiencing emotions, you're actively managing them as part of your system.
Exactly. It makes psychological management a core component of your trading system.
So after analyzing the trader, the questionnaire moves on to methodology. And the key here seems to be matching the system to the person.
Yes. It's not just about finding a good system. It's about finding the right good system for you. You have to assess if a model's strengths and weaknesses actually align with your own psychological wiring.
Can you give an example?
A classic one is trend following. A traditional long-term trend following system might have a very strong positive expectancy, but it could have a low win rate. Maybe only 35% of trades are winners.
So you're taking a lot of small losses.
A lot of small consecutive losses.
Yeah.
You're waiting for that one big winner. If you are someone who is psychologically crushed by being wrong over and over again, that system, no matter how profitable it is on paper, is not for you. That misalignment will guarantee self-sabotage.
You'll abandon it right before the big winner comes along.
Every single time. The third area is risk management, and this is where the rubber really meets the road. The questionnaire stresses that your risk controls have to be strategic, objective, not emotional.
This means your stop placement, your position sizing, It's all based on math, right? Volatility, percentage of capital, not a feeling that this trade is the one.
That's the core issue. Are your risk parameters based on statistics, or are you changing them based on the emotional pressure of the moment? And there's a really critical insight here about using fundamental information.
Right. The book says fundamentals should be used for defense, not offense. Let's break that down.
Okay, so using fundamentals for defense means you're using a major news event, a central bank announcement, a sudden regulatory change, to alert you to a potential paradigm shift.
The underlying value of the asset might have just changed.
Exactly. So that information might cause you to reevaluate your whole methodology, or at least reduce your overall exposure in that sector. You're using it to defend your capital.
But the mistake is using it for offense.
That's the classic rationalization trap. Offense is when you use fundamentals to justify breaking your own risk rules. Your stock hits its stop loss, but you hold on, telling yourself, oh, but the fundamentals are still good long term, so I don't need the stop.
It's just an emotional justification for bad behavior.
It's pure emotionalism. A master trader knows you have to protect your edge first, always. Fundamentals are just context. They're not an excuse to be reckless.
And finally, financial goals. It's about realistic drawdown management.
You have to manage your risk of ruin. The author suggests that your maximum peak-to-valley drawdown should ideally not exceed 10% of your total assets. Now, that might sound conservative, but the point is to set a predefined limit that keeps you in the game long enough for your edge to play out.
So the questionnaire is the deep diagnostic tool, but the daily practice, the tool for consistent improvement, is the trading journal. And it's so often described as powerful but underused. Why?
Because it's hard work, and it forces brutal honesty. A good journal demands you record everything. Your psychological state, what was going on around you, your internal dialogue before, during, and after the trade.
It forces you to compare what you planned to do with what you actually did.
And that's where the truth is. If you planned a 10-point stop, but you took a 50-point loss, the journal forces you to confront that emotional breakdown, to see the Mara of death right there on the page.
So you can't just forget about it and move on.
No. You learn from it. It stops you from making the same expensive emotional mistakes over and over again. Without that record, we have a tendency to remember our wins and just externalize our losses.
I've found the book's framing of psychological growth here really insightful. We tend to think of getting better as a straight line, but it's not. It's described as a spiral.
This is such a crucial and, frankly, comforting concept for traders. Growth is not a simple yes or no thing. You don't just get over fear and it's gone forever. It's more like a spiral of musical notes.
The octave idea, let's spend a minute on that because it's so helpful for self-forgiveness.
Think about it like this. Let's say the note C# represents the emotional pain of taking a loss. As a beginner, when you take a loss, you feel this loud, deafening, paralyzing C# that makes you freeze up and blow up your account. Yeah. That financial and emotional pain forces you to change. You mature. You resolve that strong, loud octave. Now, you can take a small loss without panic because you trust your system.
But then a really stressful period hits. A market crash, a string of 10 losses in a row.
Exactly.
Yeah.
And that feeling, that C# note, it comes back. But this time, it's a weaker octave. It's a quieter, less destructive note. It doesn't paralyze you. Maybe it makes you a little hesitant, a little irritable, but you still execute your stop flawlessly.
So when that feeling comes back, you shouldn't see it as a failure.
You should see it as evidence of maturation. You've progressed. You're not feeling that loud, crippling note anymore. You're just hearing a quieter echo. It prevents that frustration that makes so many intermediate traders give up because they think one moment of fear means they've made no progress at all.
That's powerful. So let's trace that journey through the stages of mastery. It starts with the beginner, who's just defined by those destructive biases.
The beginner is all about small profits, large losses, denying they're wrong.
Yeah.
And usually it takes an emotional and financial breakdown, blowing up an account, to force them to change.
And ironically, that's what pushes them to the next level.
It is. That ruin forces them to finally adopt the only attitude that works, that whatever happens, happens mindset about any single trade. That acceptance of uncertainty is the bridge to becoming an intermediate trader.
And what are the new challenges for the intermediate trader? They've had some success. They've stopped the self-destruction.
The new enemies are complacency and rigidity. They find a method that works, that gets them a steady equity curve, and then they cling to it for dear life. They're terrified of going back to the chaos of their beginner days.
So they stop learning, stop refining.
Exactly. The antidote is to keep researching, to set new performance goals, to always be optimizing your system. That keeps your mind open and inquisitive.
And finally, we get to the advanced or master trader. What sets them apart?
The master trader starts to incorporate intuition. But, and this is critical, it is an emotionally neutral intuition.
How do they do that?
They do it by constantly monitoring their own internal emotional state. They use their own feelings of euphoria or despondency as a barometer to gauge the market consensus.
So if they're feeling incredibly euphoric about a trade that's gone parabolic, they know the crowd is probably at peak greed.
Precisely. They use their own gut feeling as a contrarian indicator. They might notice that euphoric internal voice, imagining the price going to the moon, and they'll calmly say, okay, time to sell half my position and raise my stop on the rest.
So they're moving from hoping, which is emotional, to intuition, which is objective perception.
That's the leap. They recognize that the journey is fluid. There's no final destination. They're always learning, always adapting.
That's a perfect transition to the ultimate goal, which is even-mindedness. Chapter 12 captures this with a great little nickname the author's friend gave him, the I don't care guy.
It's the perfect way to put it, isn't it? Even-mindedness is about being centered. It's that middle ground between being paralyzed by fear and being reckless with greed.
And the logic is so simple. If you have a positive expectancy model and solid risk management, you shouldn't care about the outcome of any one trade.
Right. And if you do care emotionally, it means something in your process is broken. The book says it's one of 4 things.
What are they?
1, you haven't done enough research to actually trust your edge. 2, you're managing risk badly. You're probably over-leveraged. 3, you're letting the ghosts of past losses haunt your current trade. Or 4, you're just a gambler addicted to the feeling of winning. Any one of those will kill you.
So if you achieve this even-mindedness, what does your reaction look like after closing a trade? A winner versus a loser.
After a winner, the new enemy is the fear of giving those profits back. This is huge. People hit their weekly goal and then just stop trading, and they miss out on more high-probability setups.
The antidote is to remember each trade is unique.
Each one is a unique event in a probabilistic series. The market doesn't know or care that you're up for the month. After a loss, the response has to be clinical. You ask one question: why did I lose? Was it bad execution? If so, learn from it. Was it flawless execution of a good model? If so, you accept it. That was a cost of doing business, and you immediately look for the next setup.
It's all about focusing on the process, not the outcome. That's what defines the master. The book lists a few key traits.
They have this unwavering confidence, but it comes from exhaustive research, not from ego.
Mm-hmm.
They disassociate from past losses almost instantly. Yesterday's pain doesn't bleed into today's decisions.
They embrace imperfection.
Which is so important. They're okay leaving some money on the table. They don't chase missed trades. They know that trying to be perfect is the enemy of being robust and profitable.
And the foundational skill to achieve all this is something called witness consciousness. How do you get there?
Witness consciousness is objective self-observation. It's about taking a step back from your own mind and just observing your emotional and mental state without judging it, and crucially, without acting on it.
It's like you're watching a movie of your own thoughts.
Exactly. And that simple act of observation deactivates the destructive emotional cycles. It short-circuits that internal voice that's obsessing about what a loss will mean for your ego or your self-worth. By observing, you access what the book calls jhana, or wisdom awareness.
And this is used to channel the destructive vijnana mind. What's that?
The vijnana is the divided wisdom mind. It's the inner chaos. It's the part of you that's bored or prideful or scared and is looking for a destructive way to express that emotion. It's your self-sabotage engine.
So you don't repress it.
You don't repress it, you channel it. A dieter might chew gum instead of binge eating. A master trader channels their boredom or anxiety into productive work like more research, more backtesting, refining their models, instead of placing a reckless trade. It's redirection, not repression.
Flexibility and creativity are also listed as key traits for the advanced trader.
They have to be. Rigidity is the death knell for a trading career because markets are always changing. The master trader sees a setback not as a failure, but as an opportunity to see a blind spot they didn't know they had.
So how do we actively reprogram our minds? We need some practical daily tools.
The book outlines several. The first is meditation, just 10 to 20 minutes a day to quiet the mind, to reduce that mental chatter that leads to impulsive decisions.
The second is visualization, proactive mental rehearsal.
This is huge. You're training your mind for stress before it happens. You visualize the entire trade, the analysis, the entry, managing the discomfort of a drawdown, and then the flawless exit.
And you should specifically visualize the hard parts.
You have to. Visualize the P&L turning against you. Feel that knot in your stomach. Hear that voice screaming to move your stop. And then visualize yourself calmly executing the stop exactly as planned. You're building mental muscle memory.
There was also a specific visualization for getting rid of bias in a trade you're already in.
Yes, the objective viewing technique. If you're in a trade and you feel your emotions are tied to it, you mentally exit the position. You pretend you're flat. And you ask yourself, based on my system right now, is the market going higher or lower? It decouples your ego from the decision.
The third tool is affirmations.
These are for targeting those deep-seated, self-sabotaging beliefs. Things like, I am not my trades. My worth is not determined by my P&L. Or a really powerful one, realizing markets continuously offer limitless opportunities for abundance, I release regrets and fears of insufficiency.
And finally, the physical side, somatic exercises.
Mental flexibility and physical flexibility are linked. Doing things like yoga, walking, just getting exercise. It helps make the mind more flexible and less rigid, which is a huge trap for traders.
Plus, exercise is a proven treatment for mild depression, for trader burnout.
And never underestimate the power of just going for a walk. When you're stuck, when you're stagnating, walking allows your subconscious mind to work on the problem. It can provide insights that your stressed conscious mind just can't access.
This brings us all the way back to that foundational fear, the fear of the unknown outcome. What is the ultimate antidote?
It's repetition and acclimatization. That's it. Successful trading is the art of getting comfortable with being uncomfortable. You do it over and over again until it becomes second nature.
The horror movie analogy from the book is perfect for this.
It really is. The first time you watch a truly scary movie, you're terrified because you have no idea what's going to happen. The threat is unpredictable.
But the 20th time you watch it,
You're laughing. You might even be bored. You know exactly when the jump scares are coming. The predictability kills the fear. It's the same with trading.
so you just keep taking the uncomfortable setups.
You keep taking the uncomfortable, positive expectancy setups, even if you have to trade with tiny size at first to lower the stress. That repetition deactivates the fear of the unknown outcome. It slowly but surely replaces that irrational fear with cold, hard confidence in your statistical edge.
You're training your brain to understand that the monster in the closet actually has a positive expectancy as long as you follow the rules.
You are. And that unshakable confidence doesn't come from ego. It comes from research, and it's forged in the fire of mechanical, even-minded repetition. That is the final step. That's how you win like the house.
That was an incredible deep dive into what is really the most vital piece of the entire casino paradigm. We've learned that you can have the greatest technological edge, the best quantitative model in the world, but it is utterly useless without the disciplined, even-tempered mindset of a casino owner. The path isn't a straight line. It's a spiral of growth. It requires that rigorous self-analysis using tools like the trading journal, a complete acceptance of uncertainty, and proactive mental and physical conditioning to finally overcome those deep-seated psychological maras.
Indeed. We've really covered the intense challenge of doing what feels so psychologically unnatural. And this raises, I think, a really important question for you, for anyone on this path to consider. If master traders view their setbacks not as failures, but as essential data points, as opportunities to see their own blind spots and reach a new, higher octave of success, do you currently treat your trading losses as a painful, final event? Or do you see them as essential, emotionally neutral data points for your own continued psychological growth spiral?
That was a truly deep dive.
Thank you for watching. Please like, share, subscribe, follow up in the next video.